So when you think about what makes a great trading system, what's the first thing that pops into your head? For a lot of people, I bet it's a high win rate. It just feels safe, doesn't it? I mean, winning most of the time seems like the clearest, most obvious path to making money. But what if I told you that feeling of safety is just an illusion, and that the very thing you're chasing is actually hiding a catastrophic risk?
Look at this number. 90%. A system that wins 9 out of every 10 trades. I mean, that's the holy grail, right? It feels good. It's comforting. It seems predictable. It's the kind of number that makes you feel like, okay, I finally cracked it. And it's what so many traders are shooting for, especially in those super fast-moving markets like 0DT. That's zero data expiration options.
So let me ask you, straight up, does a 90% win rate really look safe to you? Just take a second and think about it. Your gut reaction is probably, yeah, of course it does. But the whole point of this explainer is to challenge that exact gut reaction.
And this is the key, in certain types of trading, especially those that are short convexity, that beautiful 90% number isn't a sign of safety at all. It's actually a huge red flag. It's a warning sign that your system is incredibly fragile and might be just one bad day away from a total catastrophic blowup.
Now look, this isn't about needing more discipline or having some kind of psychological flaw. This is not about you making a mistake. This is about the cold, hard math of the system itself. The trap is built right into the numbers, and it's been hiding there in plain sight all along.
Okay, so the core idea we have to get our heads around is something called short convexity. I know it's a fancy term, but the idea is actually super simple. You're making a trade-off. You get this steady drip, drip, drip of small, satisfying wins, but the price you pay for all that winning is that you are implicitly agreeing to take a rare but absolutely massive account-destroying loss.
And this quote from the source material just nails it. It says, "You're not getting paid for accuracy. You're getting paid for absorbing rare losses." Let that sink in for a second. Your high win rate doesn't mean you're a genius at timing the market. It means the market is paying you a tiny fee to sit on a ticking time bomb. You're being paid to take on the risk that nobody else wants.
And this is where it all becomes crystal clear, when you just look at the math. In this table, R just stands for your risk unit, whatever amount of money you decide to risk on one trade. So yeah, you're winning 90% of the time, which feels great, but your average win is tiny, just 0.3 R. But that 10% of the time you lose, bam, you get hit with a 5R loss. Let's do the math here. One single loss completely wipes out more than 16 of your previous wins. You're basically picking up pennies in front of a steamroller.
All right, to really hammer this point home, let's look at a simulation. We're going to put 2 different trading systems head-to-head. Now, on average, they're both profitable. But as you're about to see, their ability to actually survive in the real world couldn't be more different. This is a tale of fragility versus robustness.
So on the left, we've got System A, the sprinter. This is our high win rate hero with that flashy 90% number. And on the right, we have System B, the marathoner. Its win rate is a more modest 60%, but you can see its wins and losses are much more balanced. Now, just looking at this, which one would you pick?
Okay, so we ran thousands of simulations, each one for 500 trades. And you know what's crazy? Their median outcome, the typical result, is almost identical. If you only looked at this average, you'd think, hey, both systems are pretty good. You might even lean towards System A because, let's be honest, winning all the time feels better. But that median result is lying to you. It's hiding a really dark secret.
And that secret is this number, that catastrophic loss. In the simulation, the worst trades for System A always hovered around this -5R mark. This is the tail event. This is the monster under the bed that the average performance completely papers over. It doesn't happen often, but when it does, it changes everything.
So here's the brutal, honest truth about System A. Its survival, its entire existence, depends on the hope that the worst-case scenario never actually happens. It's a bet against something that is statistically bound to happen eventually. And a strategy that's based on hope? Well, that's not a strategy at all. It's just a gamble. System B, on the other hand, is built for reality. It expects to take losses. It actually has them more often, but they're controlled, they're manageable. It's designed to take a punch, get back up, and keep on trading. It is robust. And that difference, my friends, is everything.
So, how do you avoid this trap? How do the pros spot this hidden fragility before it's too late? Well, it turns out there's a really simple but incredibly powerful rule of thumb they use to tell the difference between a real edge and a hidden risk.
Here it is. This is the golden rule.
Go back and look at your own trading data. Take your single worst loss and divide it by your average winning trade. If that number you get is bigger than, say, 20 or 30, then your system isn't being driven by your skill or your edge. Your system is completely at the mercy of a rare tail event. You're just waiting for the other shoe to drop.
Okay, so we've identified the problem, we've got a rule to spot it, so what now? How do we actually fix a fragile system and build it for long-term survival? Well, here are 4 practical, actionable steps you can take.
All right, let's break these down. First up, size for survival. This just means you should base your position size on what you can survive, not just on chasing the biggest possible profit. Second, cap or daily exposure. A single trade might not sink you, but a death by 1,000 cuts will. Know your daily walk-away number. Third, filter risky days. If you know your system is fragile, just don't trade on days with huge news events or crazy volatility. Sit on your hands. And finally, number 4, track your ratio. Constantly keep an eye on that number we just talked about. If the ratio of your worst loss to your average win starts creeping above 20, your position size is too big. Period. Full stop.
You know, when you really boil it all down, it comes down to a fundamental shift in what you're focusing on. The amateur trader is obsessed with their win rate. It feels good, it's a great ego boost. The professional trader, they're obsessed with tail survival because they know that's the only thing that keeps them in the game long enough for their actual edge to pay off.
So I'm going to leave you with this one question. Take a hard look at your own trading, your own strategy. Are you just chasing the short-term satisfaction of frequent wins? Or are you building a robust process that can actually withstand the storms that you know are coming? To put it another way, is your system just built to win, or is it truly built to last?